Hey guys, what's up? Welcome back to another video. In this video, I want to talk about a really interesting stock that I found recently that could be presenting a good buying opportunity right now, and that one is A.O. Smith. And this stock is down around 30% over the last year, while the S&P 500 is down about 15%. So they are underperforming the market over the last year, but we'll see in some of the articles that I found that this stock is actually not half bad. And so we can see right here in this article, it's called My Top Industrial Stock to Buy and Hold Forever, and it's about A.O. Smith. And they quickly touch on the fact that this company has a lot of criteria for a company that won't be disrupted in obviously the modern era. It's ever evolving, and so finding companies that are still going to be relevant 10 or 20 years from now is really important. But then they also quickly touch on the fact that they have a little bit of exposure to the Chinese market, and so that could be a big concern for them moving forward. And so right here, if I scroll down a little bit, they touch a little bit about how important it is to find a company that will continue to be relevant into the future as technological innovations continue. And A.O. Smith is essentially a company that specializes in heat and hot water, just basically providing utility for residential homes as well as in commercial uses. And so they basically started in the 20th century, and the largest driver for their business is in the United States and Canada, with about 80 to 85% of their residential water heater sales coming from replacements for people who need to replace their water heaters in their homes. And on top of that, if I scroll down here a little bit, we can see they talk about how A.O. Smith and one of their competitors, Rheem, account for about 35% of the North American residential market, whereas A.O. Smith's share of the commercial market is closer to about 50%. And so that definitely gives them the competitive edge over all of their competitors because they basically own half of the commercial market by themselves. Then if I scroll down to this paragraph, they point out something pretty interesting, which is that some of their operating segments split up in 2011, particularly their auto manufacturing and electric motors operating segments. And as a result of that split, they ended up just using a lot of their capital invested in the company, and that ended up doubling from about 11% to or doubling to 24.1%. And they also talk about how 11% of their total assets per year come from their annual free cash flow. And a lot of that free cash flow they've ended up just using to grow their dividends by 650% over the last decade or so. And they've also reduced their total shares outstanding by about 16% over the last 11 years. And so that's a ton of value returned back to shareholders, mainly as a result of the fact that they have all this free cash flow and they don't really know what to do with it, so they're just giving it back to shareholders. And so the fact that their stock is down about 30% over the last year doesn't seem to be that big of a deal because they point out right here that it's a wealth compounding stock and it's pretty much quintupled the S&P 500 over the last 30 years. So it's a stock that's relevant through the decades, and they definitely prioritize returning value back to shareholders. But obviously, this company is not without fault. This part of the article talks about some of the risks that are facing this company. And in particular, they have cyclical earnings, basically meaning that their earnings aren't really that consistent because they rely on residential homes that need to replace their water heaters. And you're obviously not going to have to replace your water heater every single year. So they do have cyclical earnings in that regard. And then on top of that, they've recently started making investments in the Chinese market, mainly since the 1990s. But as a result of the global lockdown measures that went into place, as well as some of the lockdown measures that are still in place in China, it's ending up having a negative impact on their revenue and their earnings growth. But that being said, North America is where the majority of their profitability comes from. So the fact that they're diversified internationally ends up reducing the amount of risk that they're exposed to in the Chinese market. Something else I want to touch on is just in this article where they point out very quickly that they've increased their dividend consecutively over the last 30 years, with shares currently yielding about a 1.94% dividend yield. So that's pretty impressive that they've managed to consistently increase their dividend growth over the last 30 years. Definitely a good sign to see for a company if you're an investor in that company. And so right here, this is their income statement comparing their results for September 30th, 2022 to 2021. And during that time period, net sales are unfortunately down from $914 million to around $874 million. That's a decrease of about 4% year over year. And then their net income is down from $131 million to $109 million. So that's a decrease of about 17% year over year. So over the last year, their earnings have not been that good. But we saw from that article that this company obviously has cyclical earnings, and they're a wealth building stock over the decades, not just a really quick short-term growth stock in the stock market. And so right here, this is their balance sheet comparing September 30th, 2022 to December 31st, 2021. Their total assets have decreased from 3.4 billion to about 3.2 billion over that time period. And then we can also see total stockholders' equity is down a little as well from 1.8 billion to 1.7 billion, with retained earnings increasing from 2.8 billion to about $3 billion. They've also increased their treasury stock account from 1.5 billion to 1.7 billion, showing that they are repurchasing shares of common stock at the moment, trying to return value back to shareholders. And lastly, right here, we have their cash flow statement comparing the first 9 months of 2022 to 2021. During that time period, operating cash flow, as we can see right here, is down from $376 million to $214 million. But based on their financing activities, we can see they're definitely prioritizing returning value back to shareholders. They've repurchased about $282 million worth of common stock in 2022, and they've also paid out about $131 million worth of dividends. So that's a lot of value returned to shareholders, especially considering the fact that their operating cash flow was only around $214. So they're basically returning even more value back to shareholders than they're producing in the way of operating cash flow. So right here, this is a discounted cash flow model just to figure out the intrinsic value per share for A.O. Smith. And Yahoo Finance is estimating they're going to grow at about 8% over the next 5 years. They had around $566 million worth of free cash flow in 2021, with around $96 million worth of cash on their balance sheet and 126 million shares outstanding. And so that puts their intrinsic value per share at around $64 per share, which means that at the moment they are trading below intrinsic value per share very slightly at around $58 per share. So they could be presenting a good buying opportunity at the current share price. Also on the right hand side here, I compared them to some of their competitors in this industry, Watsco, Comfort Systems USA, and Watts Water Technologies. We can see that from a financial ratio perspective, they're doing pretty good. They're very competitive. They have the second highest gross profit margin behind Watts Water Technologies, and they definitely have the highest net profit margin and return on assets relative to the rest of the competitors in this industry. They have a 13% net profit margin, with second place only being 9%, and a 14% return on assets, beating out Watsco's 13%. So from a competitor analysis perspective, it looks like A.O. Smith would actually be the buy because they are performing a lot better than the rest of their competitors in this industry. And then from an intrinsic value standpoint, if they manage to grow at around 4 to 8% for the next 10 years compounded annually, then they are trading at a pretty good buying price at the moment, since they're trading below their intrinsic value per share of $64 per share. So it hasn't really been that good of a year for them. They've collapsed quite a bit, but at the current share price, looks like they could potentially provide a good buying opportunity to see some growth into the future. So I'll definitely be keeping my eye on this stock, especially considering the fact that they return so much value back to shareholders. So that makes them pretty attractive. Let me know in the comment section down below what you guys think of this stock. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.